Let's talk about 9 of the best dividend ETFs out there on the market that you can invest in today to start making some passive income. Through investing in high-quality dividend ETFs, you can build an investment portfolio that is not only paying you passive income, but is also far more diversified and less risky than any portfolio you could likely create from picking individual stocks by yourself. There are so many important things to consider when selecting a high-quality dividend ETF to invest in. These include the dividend yield, expense ratio, market cap, dividend growth, volatility, asset allocation, and historical performance. The only problem is that researching and weighing out each of these factors when choosing the right ETF for you can be quite confusing for a lot of new investors. But don't worry, because the dividend ETFs on my list rank amongst the best out there across all of the criteria I just mentioned. I'm hoping that this list will save you a lot of time and frustration, and if that is the case for you, feel free to pay me back by simply liking the video and sharing it with that buddy of yours that just lost his entire net worth going all in on FTT tokens. That would be amazing. Okay, coming in at number 9 on my list, we have PRF, which is Invesco's FTSE RAFI US 1000 ETF. And whilst the name of this ETF is kind of lame, its holdings are actually pretty cool. This ETF holds a massive portfolio of roughly 1,000 stocks designed to track the performance of the largest US stocks. The holdings are selected based on the following 4 fundamental measures of firm size: book value, cash flow, sales, and dividends. The ETF is then weighted according to a stock's score across this criteria. These calculations are done on an annual basis, and the fund is adjusted and re-weighted accordingly. And it's no surprise that one of the top holdings in PRF this year is Berkshire Hathaway, which is Warren Buffett's company. And since Buffett is viewed as one of the greatest investors of all time, I think it's safe to say Invesco does a pretty good job choosing what to include in this ETF. PRF currently pays a dividend yield that's a little on the lower side at 1.98%, but it makes up for it with great historical appreciation. The fund has returned an average annual return of 12.94% over the last 10 years, which is very high. That means that if you had invested $10,000 in this ETF 10 years ago, your investment would now be worth $33,766. The expense ratio, which is basically the cost of owning the ETF, is a little above average at 0.39%, which means you would pay $39 annually for every $10,000 invested. Coming in at number 8, we have a Vanguard fund called VYMI, Vanguard's International High Dividend Yield ETF. This is the perfect dividend ETF if you want to gain exposure to stocks outside of the US. With roughly 2/3 of economists predicting that the US will enter a recession by mid-2024 and the 10-2-year Treasury yield curve remaining inverted for several months now, you might be thinking that it's a good idea to diversify your portfolio away from the US stock market. Well, this fund helps you do that by offering global exposure to 1,326 stocks outside of the US. Some of its holdings are companies that you would have likely heard of, such as Nestle, Shell, and Toyota. The highest proportion of stocks are European, followed by the Pacific and emerging markets. It's the 21.7% share of emerging market stocks that make this ETF the most risky one on this list. Emerging markets is another term for developing nations. These countries have weaker economies, which means that the stocks from these countries are likely a riskier investment, which is probably why Vanguard's risk rating is a 5 out of 5 for this ETF. This ETF shows why high diversification does not necessarily mean low risk, because this ETF offers the best diversification on this list, but is also the riskiest. VYMI has a strong focus on high-yielding stocks with a current dividend yield of 3.55%, which is roughly 2 times the typical S&P 500 stock. This ETF was created in 2016, so we don't have a 10-year annual return we can look at, but its average annual return since inception is 7.03%. It also has a relatively low expense ratio of 0.22%, meaning that on an investment of $10,000, you would only pay $22 a year in fees. Coming in at number 7, we have DIA, also known as the SPDR Dow Jones Industrial Average ETF Trust. This ETF was designed to track the performance of the Dow, which is made up of 30 of the top blue chip stocks in the US. There's not really specific rules that decide what companies are included in the Dow. Instead, it's done using a more qualitative approach. It's said that for a company to be added to the Dow, it must have an excellent reputation, demonstrate sustained growth, and be of interest to a large group of investors. All of these factors help ensure that your dividend payments are safe and reliable. But speaking of safety, I'm excited to partner with today's sponsor, Aura. Aura is an easy-to-use app that includes everything you need to stay safe online, like identity theft protection, fraud monitoring, a VPN, and an antivirus software. Aura protects you from scammers and hackers by scanning the so-called dark web, where criminals sell stolen information information, looking for your emails, passwords, and social security numbers. When I entered my email into Aura, they scanned the dark web and found that my email and password had been compromised more than 5 times. And Aura has a password manager that lets you store and access your online passwords securely and conveniently. Aura gives you near real-time alerts on suspicious credit inquiries, like if someone was opening a loan or credit card in your name. Their VPN allows you to stay anonymous online by keeping your browsing history and personal information safe and encrypted. And they protect your devices from viruses, malware, spyware, and more, so the bad guys can't break in. Maybe you already have an app that does one of these things, but with Aura, you don't have to download and pay for 7 separate apps. Let Aura do the hard work of keeping you safe online. If you sign up right now, Aura will give you a 2-week free trial with my link. You'll be shocked at how much of your private information Aura finds exposed over those 2 weeks. Go to aura.com/Carson to start your free trial. It's also linked below in my description, or you can scan the QR code on the screen. And with that said, let's get back to talking about DIA. You've probably heard of or had your life affected by all of the companies included in this ETF. DIA includes massive companies like Apple, Home Depot, Coca-Cola, McDonald's, Walmart, and Disney. Currently, DIA is paying a dividend of only 1.86%. I know that's not very high, especially compared to some of the ETFs on this list, but as a general rule, the lower the dividend yield of an ETF, the more likely it is to experience higher growth in terms of price appreciation over a long time period. And DIA has obeyed this general rule, since it has averaged one of the highest annual returns on this list in the last 10 years at 12.68%. That means that if you had invested $10,000 in this ETF 10 years ago, your investment today would be worth roughly $32,997. This ETF also has one of the lowest expense ratios on this list at 0.16%. Meaning that on an investment of $10,000, you would only pay $16 a year in fees. Overall, if you're looking to invest in the highest quality companies that are most likely to perform well over a long time horizon, and you don't care as much about receiving a high dividend yield, then DIA is a fantastic choice. At number 6, we have VIG, which is Vanguard's Dividend Appreciation ETF. This fund seeks to track the performance of the S&P US Dividend Growers Index. VIG is comprised of 289 stocks that have increased their dividends annually for at least the past 10 years. This ETF currently has a dividend yield of 1.81%, which is on the lower side of this list. But like I said before, the general rule is that the lower the dividend yield of an ETF, the more likely it is to experience higher growth in terms of price appreciation over the long term. VIG has averaged an impressive annual return of 12.51% in the last 10 years, meaning your $10,000 would be worth around $32,509 today. Compared to other dividend ETFs, VIG is more concentrated in growth companies in higher growth sectors such as tech, so it's more on the riskier side. But it is still a dividend ETF at the end of the day, so its risk level isn't as high as other types of stock investments, but it's certainly on the riskier end of ETFs on this list. VIG also has an incredibly low expense ratio of just 0.06%, which means you would pay $6 annually for every $10,000 invested into this fund. 0.06% in fees is very good, and ties for the lowest expense ratio of the ETFs that I'm covering today. This is also the most popular dividend ETF currently on the market, with $67 billion in assets under management, so you can't go wrong with this one. At number 5, we have VNQ, or Vanguard's Real Estate ETF. This fund invests in real estate investment trusts, which are public real estate companies that purchase office buildings, hotels, and other real estate property. Every good investment portfolio should be invested in multiple asset classes, not just equities, so this is a must-have for your portfolio as it provides you diversification outside of stocks and into real estate. Currently, this index fund holds 166 real estate companies, including the likes of Public Storage and Simon Property Group. This ETF currently has a dividend yield of 3.62%, which is on the higher side of this list, although its dividend has historically been quite volatile. VNQ has returned an average of 7.36% annually over the last 10 years, meaning a $10,000 investment in this ETF 10 years ago would now be worth $20,343. VNQ also has a very solid expense ratio at 0.12%, so you would pay $12 annually for every $10,000 invested in this fund. Moving on to number 4, we have an iShares ETF, DVY. Also called the iShares Select Dividend ETF. This ETF is designed to provide diversified exposure to high dividend paying US stocks. Currently, it holds 98 stocks, most of which are large cap stocks, and all of which have a 5-year record of paying dividends. Currently, the ETF has a dividend yield of 3.47%, which is pretty good. The ETF has also had an average annual return of 10.1% over the last 10 years, meaning a $10,000 investment in this ETF 10 years ago would now be worth $26,174. The expense ratio on this fund is slightly above average at 0.38%, which means you would pay $38 annually for every $10,000 invested. Overall, I wouldn't say this ETF excels in any particular area, but it does, however, score pretty well across all of the different factors. It has a good yield, is well diversified, has a long history of dividend payment growth, and has a decent expense ratio, making this overall a pretty good choice. But if this one isn't for you, there are a lot of better ETFs to come, so make sure you stick around to the end of the video. At number 3, we have a really great ETF. NOBL, which is the ProShares S&P 500 Dividend Aristocrats ETF. NOBL tracks the S&P 500 Dividend Aristocrats Index, which is made up of stocks from the S&P 500 that have increased their dividends for at least 25 consecutive years. As you can imagine, a company increasing their dividend for 25 years is no simple feat. If you think about it, in the last 25 years, the US has experienced 3 recessions: the dot-com crash of the early 2000s, the 2008 Great Recession, and the recent 2020 recession, which means that during all of these hard economic times, the 64 stocks in this ETF were still able to increase their dividends year after year. So this is definitely the best ETF for you if you're prioritizing ETFs with a good track record of dividend growth. NOBL currently pays a dividend yield of 2.11% and was created just shy of 10 years ago. So again, we don't have a 10-year return we can look at, but the average annual return since inception is 11.33%. NOBL also has a below average expense ratio of 0.35%, meaning that on an investment of $10,000, you would only pay $35 a year in fees, which isn't too shabby. At number 2, we have SPHD, which is Invesco's S&P 500 High Dividend, Low Volatility ETF. This fund invests at least 90% of its assets in S&P 500 stocks that have historically provided high dividend yields and low volatility. The S&P 500 is an index made out of 500 of the biggest and best companies in the US. The fact that out of these 500 companies, this ETF chooses the highest dividend-paying companies with the lowest volatility makes this a must for your dividend portfolio. This ETF holds 51 stocks and is currently paying a dividend yield of 4.34%. SPHD has averaged an annual return of 10.1% over the last 10 years, meaning a $10,000 investment in this ETF 10 years ago would now be worth $28,497. And this fund has a relatively low expense ratio at 0.3%, a cost of only $30 annually for every $10,000 you have invested. So overall, SPHD has averaged a high return in the past, has a good dividend yield, a low expense ratio, and is full of very high quality companies, making this an amazing investment to own for the long term. Finally, at number 1, we have SCHD, also known as the Schwab US Dividend Equity ETF. Charles Schwab is one of the most trusted companies in the finance world, and its funds are known for their fantastic performance. SCHD was designed to track the returns of the Dow Jones US Dividend 100 Index. It holds 106 stocks and provides exposure to many of the strongest dividend payers in the United States. Currently, SCHD pays a dividend yield of 3.33%, which is one of the higher dividend payers that I've talked about today. This ETF has averaged the highest annual return on this list of 14.12% over the last 10 years, meaning an investment of $10,000 made 10 years ago would now be worth $37,464. And this fund also ties with the lowest expense ratio on this list at 0.06%, a cost of only $6 annually for every $10,000 you have invested. The fact that this ETF pays a high dividend, has the highest annual return in the last 10 years out of the ETFs I've mentioned, and also ties for the lowest expense ratio are the reasons why this dividend ETF is my number 1 pick. But those are my top 9 ETFs for today. Let me know if I left any of your favorites out in the comments below, and I'll see you in the next one. Take care.